Mindy Strong, and this video is going to be about other investments. We are in the second section, investment vehicles, in the Series 65 study program, and I am going to try to help you understand the other investments section. Here we go. What should be considered when evaluating a limited partnership? So first of all, these are obvious. Economic soundness, program objectives, and do the tax benefits outweigh the risk? Often the tax benefits are the reason or one of the reasons someone enters into a limited partnership. So there are some things to consider. First of all, a blind pool. The objectives are stated, but the exact investments are not known. This can be risky. What is the track record? What's the performance in the past? What is the sponsor compensation? Is it a reasonable fee? And are there any existing conflicts of interest? Okay, there is something called a swap, and a swap is a derivative contract where groups exchange benefits, and this is usually by exchanging two cash flow instruments. Pretty simple concept, they swap. It offsets a risk for two big entities, and there's no real trading of these. These are for the big dogs. There's also something called an interest rate swap. This is when two entities exchange cash flows from a floating rate loan for those of a fixed rate loan. They can take advantage of the other side's ability to get a better rate. Interest rate swap, from floating to fixed. And then we have currency, commodity, and default swaps, and these are basically bets on whether a bond or a company will default. Okay. Venture capital funds. Venture capitalists are people who, or companies who invest in startup companies with the potential for growth. So they're new, they're babies. When a number of investors pool their money to do this, it's called a venture capital fund. These are private equity funds, and this is high risk, but there's potential for high return. You can minimize the risk by spreading it over many different startup companies and also having the more investors in that pool. Okay, there you go, venture capital funds. Employee stock option plans. These are incentives for employees, and by offering these, it improves the company share price. Duh, you're selling more company shares. And the employees pay the grant price. So they can either be qualified or non-qualified. Qualified have no tax consequences until the stock is sold. The profits are taxed at long-term gains rates, so that's good. And they are not taxed until they are sold. They're qualified. You are qualified to hold on to your money and not pay taxes for a while. You can wait to pay the IRS. Non-qualified must pay the taxes on the difference between the exercise price and the stock market value. The tax rate is the employee income rate, so they have to pay it. Non-qualified can be transferable, and qualified cannot. Social Security benefits. Look how happy these people are. Okay. They have worked long enough to qualify for Social Security. So Social Security benefits are for people become eligible once they have 40 calendar quarters of work under their years. That's 10 years. The highest paid 35 years of work count. So let's say you work for 50 years. You can choose the highest 35 years to count towards what you earn in Social Security. It's taxable at a percent based on your income. The maximum benefit age is 70. Does not help you at all to wait until after you're 70 to start collecting it. You get the full benefit if you wait until 67. And you can start getting it as early as age 62. And a non-working spouse can claim 50% of that. Okay, we're going to really shift and talk about crypto series. Okay, crypto. It's a digital payment system that does not rely on banks. It uses blockchain, which is a ledger, to store, record, and validate the transactions. There is something called mining. That's the process used to actually create the cryptocurrency. And then there's owning. When you own cryptocurrency, you actually own the key so you can encrypt and decode the currency. Think of a key in terms of like a puzzle, and having the key to understand what the puzzle is saying. And the wallet holds the key. The key is used to decode. It's a decoder. The value of the cryptocurrency is based on the supply and demand, market sentiment, government regulation, and media coverage. Duh, right? We know these are extremely volatile. There's something called Bitcoin Trust. Bitcoin Trust contains Bitcoin tokens, and they are sold to investors. Blockchain stocks, or ETFs, are shares of stock that are transferable. They are transferable. And Bitcoin mutual funds contain Bitcoin tokens or shares of blockchain company stock. There are benefits to cryptocurrency and there are risks. Some of the benefits include privacy and security. There can be two parties involved in a transaction and they are not identified to each other or to the public because it's difficult to get into that system. Remember, you have to have the key to decode it. They're extremely portable. You can use them anywhere you have the internet. It's very transparent. You can't hide your transactions. And there's an argument that it's the equality of opportunity. Anyone with the internet can do it. There are some obvious risks. There is extreme price volatility. We just looked at that. Based on the media, supply, demand, government regulation. There's no central bank to control the supply. So new rapid swing prices are common. There is not much opacity of markets. There's very few regulations in place. Potentially untraceable issuers. Users can be anonymous and it's hard to trace and recover lost funds. Therefore, there's a prevalence of scammers and fraud is extremely possible. Now we're going to look at REITs. These are real estate investment trusts. They're similar to closed-end investments. These are investments in real estate, construction loans, mortgages. Now, 75% of the income for these must be real estate related. So that's from rent, mortgage interest earned, gains on property sales, incomes from foreclosures, and tax refunds. They're comprised of tradable shares listed on an exchange so they can easily be turned into cash. They are registered and they are regulated. And a trust is a legal entity that is managed by a board of trustees under a trust indenture. Okay, so that's the definition. The legal entity managed by a board of trustees under a trust indenture, and these are real estate investment trusts. The equity component in these is small because they borrow large amounts of money, and the debt is often 3 times the equity base. Types of REITs. First of all, the definition of leverage. That's the amount of debt outstanding. Equity REITs, invest mainly in properties, rent, operating expenses. They are not highly leveraged. That means there's not a large amount of debt outstanding. However, mortgage REITs are highly leveraged because They earn between the small spread between the borrowing rate and the income from the mortgages. So they're highly leveraged. And then there's combinations, which are equity and mortgage. And then the taxation on RITs. We have, and I already talked about this briefly, but subchapter M doesn't have to pay taxes on distributed net income, but they must derive at least 75% of the income from real estate and distribute at least 90% to shareholders. Types of RITs. So again, leverage is the amount of debt outstanding. Remember that. Non-traded RITs. These provide a high level of stable income by investing in safe, established rental properties. Retirees love these because they are safe and they are predictable. They do not trade. You keep them for 7 to 10 years and the proceeds are sold to the investors. However, these are illiquid investments. You can't get out until the trust is terminated. Okay, but they do provide a high level of stable income, so retirees love that supplemental income. Hedge funds. Okay, hedge funds are private investment funds for wealthy investors. They are lightly regulated. They're often set up as limited partnerships. They use aggressive investment strategies, and the managers can obtain high fees for this because they can get performance fees in addition to their standard fees. Okay, limited partnerships. A corporation is taxable on the net income of the corporation. A partnership is not taxable as an entity. Each partner pays taxes on their personal tax return. Direct participation program is something that partnerships are called because they directly participate in the gains and losses of the business. And two examples are real estate limited partnership and oil and gas limited partnership. And the tax shelter setup is as follows. There's one general partner, manager, and one limited liability partner. The limited liability partner has the right to inspect the books, the right to sue, pro rata share of income and loss, and they can vote on new general partner or sales of assets. Now, they can inspect the books, but they cannot request an audit of the books. Okay, so let's look at the tax benefits. Well, real estate limited partnership, depreciation is a write-off that's allowed, but the actual investment is probably appreciating. So interest on the passive mortgage is deductible in full, and tax credits are available for investing in low-income housing. Oil and gas limited partnership, the cost of drilling for oil is deductible, and the depletion deduction as oil is sold is also awesome. However, these are illiquid and there's really no trading market. They're hard to sell. The general partner can also assess, also known as request, more money from limited partners. So this is risky. Exchange traded funds. Okay, these are index fund shares. So they're shares of ownership in portfolios of common stock that track the performance of an index, and they are negotiable. Arbitrage of these keeps the price at NAV, net asset value. They're registered as open-ended funds because of arbitrage. They're passively managed because they're index funds, so there are very low fees associated with them. And they have an NAV based on the value of the underlying security. There's no credit risk, but there is market risk. Okay, what are advantages of exchange-traded funds over index mutual funds? Well, exchange-traded fund prices are constantly being updated based on stock index, where mutual fund prices are updated once a day. There are no sales charge on an ETF, but There are regular stock commission charges for buying and selling. ETFs can be purchased on a margin and can be sold short. Expenses are similar to or lower than mutual funds because there are no 12b1 fees. And ETFs are tax efficient because you don't have to give capital gains annually like mutual funds. And taxes are due on ETFs when the shares are sold. So that's cool. There are types of ETFs. There are leveraged ETFs, which are designed to move faster than the market. And there are inverse ETFs, which are designed to move opposite the market. There are open-ended and closed-ended funds. We've already talked about these, but I want to go over them again. Open-ended funds, mutual funds. Remember, you are mutually open to having fun. You are open to mutual fun. Redeemable at NAV with a fund company. They're bought from a fund company. They're only bought and sold at NAV, never at a discount. Never at a discount. Open-ended are never sold at a discount. Closed-ended, these are one-time issuance of stock and then they close. They list and trade like any other stock, and you can trade them for less than NAV, which means at a discount. Okay, unit investment trusts. These are little boxes of bonds. Shares of beneficial interest, undivided interest in the portfolio of securities. These are redeemable with the sponsor at any time at net asset value, NAV. So there are fixed UITs. Sponsor selects a fixed portfolio, puts it in a trust. The units are sold, and once this is created, there's no buying or selling of the securities within the portfolio. They're just in that little bag of bonds. Fixed municipal UIT is a way to package municipal bonds, and the sponsor creates a portfolio of the bonds. These are registered with the SEC, and they are sold with a prospectus. Accumulation account is the account that holds the bonds until the trust is created. The portfolio is created, and the bonds are moved into the trust. The trust self-liquidates when all of the payments have been made. They have low expense ratios because there's no management, no brokerage fees, and you can redeem them at any time. Index-linked structured products. So structured products are derived from a basket of securities. They have a bond portion which pays interest, spelled wrong, interest based on an index. They are bond-like, but they're not a bond. And the rate of return is linked to an index. They have a derivative component. You can sell the security back at par at maturity, 3 to 7 years. And the principal is protective if it's held to maturity. There's little trading. These are really, you buy it and you hold it. Okay, market index linked CDs. These are tie investment return to an equity index. You can impose a penalty. A penalty can be imposed for redeeming early. So there is market risk for these. They can only be redeemed at a preset quarterly dates. So there's liquidity risk. They are backed by faith and credit of the bank. So there's credit risk. And there's often a cap and a floor on returns and a participation rate. That's market index linked CDs. Exchange traded notes. These give a return linked to a market index. They have a set maturity date. They're backed by a credit rating of the bank. They're listed on an exchange and they trade in the market. So you can get out whenever at the current market price. There's no marketability risk. There is credit risk if the issuing bank fails. There's no liquidity risk. They are tax efficient because capital gains are at 15 to 20%, 20% being max. No portfolio. They are just tied to the performance of an index. Okay, derivatives. So derivatives, also known as options, are contracts between two parties. And I really hope you can use these images to help you, because I want you to understand this. Once you understand this concept, it's pretty straightforward. There are two people involved. There is a buyer and there is a seller. We like to use lots of different vocabulary to make it challenging. So the buyer is also called the option holder. So do you see her? I have her holding an option. She's considered to be long the contract. That's what it's called. She's long the contract. And then let's look at our seller. The seller is also called the option writer. So the buyer is the option holder. She's holding the option. And the seller is the option writer. See how I have him with a pen and book in his hand? And he is short the contract. So the seller's short, and I made him a little bit short. Okay. Now there is something called a call and something called a put. So the buyer is the one in charge here. And the buyer says, I would like to call this option. I would like to be able to buy it. I want to call it from you to me. I want to be able to claim it. I want to take it. I want to buy it. I want to call it from you to me. That's a call. A put is the buyer says, I want to be able to sell this to you. I want to be able to put it to you. If I don't want it anymore, I want to be able to sell it to you. That is a put. The buyer is making these determinations. Okay. Now, in order to make that deal, the buyer is going to pay a premium. Okay, we'll come back to that. If the contract expires, then the holder is going to lose the premium and the writer is going to gain the premium. The premium is the price the holder pays to the writer to agree to the deal, basically. And there are three options. Either it can be exercised, it can expire, or it can be traded. So we're going to look at four options here: a call contract and a put contract. First, we're going to look at the two options in the call contract. So the call holder wants the product they want to lock in a price, and then they want the value to go up, but they've locked in a price. So they go, hey, I know that thing is selling for $25, but we locked in this price at 20. So you have to sell it to me at 20. So the call holder wants the market to rise because they've locked in a price. So they gain when the market rises. They are in the money. Now, what happens when the market falls? Well, the call writer, if the market falls, then the buyer is not going to want to pay that lower price, right? It's not going to want to pay the higher price when the price has fallen. It's not worth as much. So the writer is going to keep the premium. So the writer wants the market to fall when there's a call. And then we have a put contract. So in this kind of contract, the buyer says, I get to sell this to you whenever I want. So let's say that there is an item that the buyer has and they agree to a price, and then the market falls. They get to sell that item to the writer at the agreed upon price, which is going to be over the current market price. And they will make the money of the difference, subtract the premium from the earnings, and that's how much they make. Now, a put writer is going to get to keep the premium if the market rises. So they're willing to sell it at this rate, but then the price goes up. They're going to go, yeah, never mind. The market rises, and never mind. I'm not gonna do that. I'm not gonna sell it to you for this lower price. So the writer gets to keep the premium. Hope this helps make sense. Okay. So if the holder decides to trade the contract before it expires, the holder gains if the premium received is more than they paid in premium originally. So if they trade it, then they can get a premium for that. And as long as the premium they get is larger than the premium they paid, they can also be in the money. Now, call contract exercised. So the holder buys from the writer at the strike price. The amount of money they can make is unlimited. So they gain when the market rises, and they exercise this when the market rises. They lose their premium if the market falls. And put contract is exercised. The holder sells the security to the writer at the strike price. The maximum is the strike price minus the premium, and they gain when the market falls, and they exercise when the market falls. Okay, I already gave the example, so I'm not going to really go into it, but the holder buys from the writer at the strike price, and we basically went over this. So if the price of this phone falls to 25 versus the price rises to 100. So if we have a $50 phone and the price falls to 25, are we going to want to sell it for 50? Of course not. But if it rises to 100, we're going to sell it for 50. Sorry, if it rises to 100 and we can buy it for 50, cool. We're going to do that. Make sense? Those are our call options. There are 4 basic option positions. There is a way to protect a long stock, and that is to buy a put. So in a falling market, you can sell the stock at the contract price by buying a put. Protecting short stock, you buy a call. So in an upward market, you can buy the stock at the contract price. You can earn extra income on a long stock. If you sell a call in a neutral market, you can wait it out until the call expires and collect the premium. Okay. Futures contracts. So a futures contract is a contract to take delivery of an asset at a future date at a future fixed price. These are standardized and exchange traded. 2 parties agree that a buyer will buy a physical asset from the seller on a future date, and the seller agrees to sell the physical asset from the buyer at the future date for the agreed upon price. Unlike with options, it's not optional. The contract can be sold prior to the date specified. However, these are usually done with physical commodities, currency, government bonds, and stock indexes. Forward contracts. Basically, this is a custom contract between 2 people. It's negotiated between a buyer and seller, and there's very little market for these because they are highly customized. And that is the end of our section on other investments. I hope this has been helpful. I know this video is a little bit longer. There was a lot to cover in there.